Welcome to your first time home buyer guide. We're going to go through all steps from beginning to end, so grab some coffee. Let's get started. You're probably renting right now and you want to start the path of homeownership. This process does not have to be stressful and full of anxiety. Understanding the steps will make you enjoy the process. Step 1. Planning your budget. Understanding how much money you make is a crucial part of the whole component of homeownership. How much are you looking to spend on your mortgage? Only you can decide on your budget. Now, we need to figure out your budget in two ways. Planning on your budget is the most important thing. So let's figure out the first step in determining how much you qualify for. Generally speaking, lenders will approve your mortgage based on 45% of your monthly gross income. If you want to find out how much you qualify based on current market rates, send me a message to #MaxMortgage. Now let's review your components of your mortgage payment. Generally speaking, there are 5 components on a mortgage. First is principal, second is interest, third is real estate taxes, fourth is insurance, your fire and dwelling insurance, and fifth, if you are putting less than 20% down, generally there is something called PMI or private mortgage insurance. If you're buying a condominium, part of the equation lenders have to take account for is your condominium fee. Now, with the craziness of the market, it's important that you realize that your budget is determined by all those factors we just talked about. But one of the very most important ones is interest rates. Interest rates, as they go up, they erode your ability to borrow. Erode meaning it's going to decrease your buying power. As rates go lower, the same amount of money you make per month will allow you to buy more. Therefore, it's important that you realize that as rates continue to move upwards, your pre-approval may be lower on a weekly, monthly basis. So it's always good to check with your mortgage broker. Second key component on planning on your mortgage is how much out of pocket you have to contribute towards the purchase of your home. There are some programs if you are a veteran where you don't have to put any money down. If you are buying on a rural area such as a USDA loan where you don't have to put any money out of pocket. But generally speaking, if you're buying a property, you're going to be looking into a 3 to 3.5% as a minimum down payment. And it's important that you know that these programs oftentimes have the capacity to change because lenders or the government, whoever is looking or whoever is creating the guidelines for said programs have the ability to change those programs. So it's always good to stay tuned to see what is that you're going to be putting. For example, you're buying a $100,000 home, so 3.5% is $3,500. Again, just to make it simple math, $100,000, 3% down, $3,000, $500,000 is $15,000 down payment on the purchase of your home. It's not all though. Closing costs can be a big part or a big component of the purchase of your home. Generally include lender fees, broker fees such as appraisal, credit reports, determination of your flood if the property is in a flood zone, and recording fees and tax fees, tax service fees. Now there are other closing costs that can be part or you can actually look out and get yourself as a quote. For instance, if you have your own attorney that specializes in real estate, you can hire your own attorney and they can provide you with something called title insurance. So attorney fees, generally speaking, have a big chunk of a percentage on closing cost. Recording your documents once you've closed has a cost associated with it, and having the attorney draft a purchase and sales agreement and represent you also can be a costly, not so much, but it also can add up to your closing cost. Now, many brokers or mortgage companies tell borrowers that a big part of your closing fees is also the first year of your homeowner's insurance, as you are required to have homeowner's insurance, 3 months of taxes, interest that is due while you begin to own the house and prior to making your first mortgage payment, and then the opening of an escrow account. Working with a mortgage broker, it's said to save buyers about $9,400 when you are using a mortgage broker. Food for thought on that. Now let's talk about who pays for closing costs. Closing costs can be paid by the buyer. Closing costs can be paid by the seller. Closing costs can be paid by the bank, the lender. Normally, if you're going to be negotiating seller pay closing costs in a market such as in a seller's market, it may be somewhat difficult, but that can be achieved. Depending on the type of loan that you're financing, you may be allowed to even use up to 6% of your purchase price to pay towards closing costs. In an example that we just gave earlier, if you're buying a $500,000 house, you can use up to $30,000 in closing costs to pay for your year insurance, your taxes. You can even prepaid all the interest, or not all, but a majority of the interest for the first 2 to 3 years. It's called a buy down. As important as that is, always make sure you have a mortgage broker that has the experience and the know-how to guide you through the process. Conventional loans have a lesser allow percentage for you to get money paid by the seller in closing costs. So it's always good that you check with the bank, because this negotiation is done at the offer time, not after. It's done at the offering. Once you submit the offer to the seller and he accepts it, that's where you had your chance to negotiate. Third, lender increases the interest rate, therefore creating money out of thin air. It's really not out of thin air. If the current rate is 3%, the lender increases the rate to 3.5%, therefore giving you the ability to get maybe 2 or 3% towards closing costs. So who is paying for closing costs? The lender is, but you are paying for the closing costs because your mortgage payments go up because your interest rate goes up. Another cost that is also associated with the home ownership is paying for the appraisal and paying for the home inspection. Home inspections don't necessarily have to be had when you're buying a property, but they're highly encouraged, because you're not a contractor unless you are. But if you're not a contractor, you need to know all the small or big items that you're going to need to be replacing or you need to change because they're not working properly. We will be reviewing those at later episodes, so please stay tuned. Okay, let's go back and try to understand, why is it that you're looking to purchase a house? Why is it that you want to own a home? The need can be as easy as, hey Diego, I want to invest for my family, and property values are high, but I know that I am better off being a homeowner than being a renter. Sometimes people have a high rent, and when you start to look at the months and the years that you've been paying rent, you realize that after months and years, you have nothing to gain other than lost money in rent. I mean, you paid for a service, which was you living under a roof, but you have no ownership of that rent paid. So it's important that you realize that home ownership has a lot of advantages and maybe disadvantages as well. Some of the advantages are pride of home ownership. Maybe a tax deduction on interest. Third, ability to stay where you are until when you want to leave. This is a key component in many places. Because if you're renting now and the owner of the property decides that you gotta go, what do you have to do? If you've been paying lower rent and the owner decides that it's time to sell, what are you gonna do? So it's important that you realize that that third component is your ability to stay where you want until you want is key. Fourth is the ability to do whatever renovations that you want to your house. You don't really do too many renovations or improvements on the rental that you have, but have you ever thought about having a jacuzzi in your property? Have you ever thought about making that reno on a bathroom? Or have you ever thought about doing something crazy in your kitchen? Those can be great advantages of being a homeowner. Now, more advantages of being a homeowner has got to do with rental property. And this video does not cover rental property as income producing property, but stay tuned for those videos because we will be going into depth as to how it is that it makes sense for somebody who has high income to be able to take in those rents and depreciate the property that you've bought and add in all the taxes and expenses that can make your rent go a long way.